And we're live.
Easy for you to say. Just so I can see it. Let's see if we're live. Well, nothing on the YouTube yet.
There's a delay. So,
And I just heard you say you're live. All right, I got to turn that crap off or I'm going to be distracted because I'm listening to us talk to each other.
all right. Here we are, February 18th, a little after 4 o'clock.
Happy Valentine's Day, Ricardo.
Yeah, a little late. A little late on that. But Valentine's has come and gone this year, Rob. I mean, so let's talk about something a little more serious.
Okay.
How does somebody that just met on Valentine's Day buy a house? Their first house.
Well, that'd be a big mistake.
Oh, really?
If you're not married. I mean, you can buy a house if you're not married, but it just opens up a can of legal worms. But we won't get into that. But you can. So either way.
Right.
So I guess we can run through the LTVs, loan to value, or we can run through the programs, or a combination of bouncing back and forth.
Well, I mean, when it comes to a first time home buyer, somebody that's never, ever had owned a property and they've always been renting, paying their rent to their great landlord, and every year or every 6 months, they see that rent start to increase, right? And they're like, geez, honey, maybe there's a, opportunity for us to buy something. Our rent's getting pretty high. Let's start taking a look at what we can do. What programs exist?
So before we even talk about that, let's do a quick recap of things we've talked about before. One is you're going to want to pull your own credit report through the credit bureaus. You're offered a free copy every year, and you're going to want to go through all three of them: TransUnion, Experian, and Equifax. And you're going to want to get your free copy through them. If you go to one of their websites, it'll take you to the main one, and then you can order all three. You're going to want to go through that, make sure everything's correct on there. If there's anything incorrect, then you may want to dispute it, or you may want to try to correct it through the creditor. So if it's a creditor you have a good relationship with, they can remove it really quickly. If you dispute it, it's going to delay your start on looking for a home until that dispute is over, because you will not be able to get a loan if you've started a dispute. The other thing you're going to want to do is determine how much house you think you can afford. So this is something that happens a lot. Is I'll have somebody that contacts me and I'll ask them, well, what kind of a payment do you think you can afford based on your income? And they'll tell me $5,000. And then I'll say, what are you currently paying rent? And they'll say, oh, we pay $1,600 a month. And they may or may not be able to afford $5,000 a month, and they may just be living below, their budget. But
Right.
what I always suggest for them to do is to set up a new bank account, just a savings, take the debit card and throw it in the drawer. Don't carry it with you. And then every month you write a check for the difference of that $5,000 in your rent. So you subtract it from your rent is $1,600. You subtract that from $5,000. You've got.
You transfer $3,400 into your savings account.
But it's $3,400. So you're going to write a check for $3,400 into that bank account. Now that's going to do one of two things. It's going to let you save some money that you would normally be paying towards a mortgage, and once you get it, and so that when you get to closing, let's say you don't find a house for 6 months, well, that's a lot of money you've saved up. The other thing it's going to let you do is to determine if you can live off of that new payment, which is really important because you don't want to have payment shock down the road. And
right.
so for 2 or 3 months, you're going to be making that payment, and you're going to forget that you have that money. You're locked that away. It's not to, you have to assume that it went to a bank and you're not getting it back. And if you can do that 3 or 4 or 5 months, you start to realize how it affects your personal life and your lifestyle, and you may then adjust it. You may say, "Ooh, $5,000 a month is too much. I think I only want to do 3,000." So reduce it down, and then see if you're still able to have the life, so that you don't become a slave to the mortgage or to the house, and you still can have a somewhat of a social life. Because when we look at your documents, we're only looking at certain documents, but you have other expenses that come up. You know, you go out to dinner, you pay cash, you do other things, you pay cash for them, and
Right.
it's just good to be able to see if you can live off of that budget that you're trying to set for yourself. So that's the first thing. Then it gets down into the programs, and once you pull your credit and all that, we'll review it, and then we'll look through the choices. But here are some. So first you have FHA, and this is basically for all credit scores. Generally, we use it for people that are first-time home buyers. It's primarily a primary residence loan. So you would use it for a first-time home buyer on 1 to 4 unit properties. So you could technically buy a 4-unit property, live in one of the units, rent the other 3 out to subsidize the payment. On those loans, you're going to go to 96 and a half. Did I do it back? Can I go backwards? No. Is it 96 or 95? I just go blank. 96 and a half. So you go to 3.5% down. And
Got it.
Right.
That's under the FHA guidelines, up to 4 units.
Right.
Correct.
The nice thing about that is they will also do people with poor credit or no credit. So they will do an actual manual. Some lenders will allow a manual underwrite. Now that could affect your loan to value, your LTV.
Which means you might have to come in with a little more money out of pocket, right. Not 3.5%, maybe 5%, maybe 6%, depending on what the underwriter.
10 or 15 or whatever.
Right.
Depending on what you can qualify for. And so they'll do a manual underwrite of your situation, and even though
you mentioned one thing that I think we should expand on just a few moments on. When you say not so perfect credit, I guess what does FHA allow at up to 96.5% of the value of the value of the property, to where you only have to come in with 3.5% down payment? What is the credit, the normal credit range they're looking for? As low as what? Is it as low as 680, as low as 660, as low as 620, 600, 580? What are we talking about there?
Give me 1 second. I got a good one to pull up. Hold on. When you get down into these crazy numbers, you got to look it up, because they're limited on also who's willing to do them.
Right.
So, so there are some places that'll claim they'll go down to as low as a 500. 550 is a manual underwrite, and they'll advertise it as 100% with gift funds. So you got to be careful with that. So here's one that'll go 580 to 90%,
mm-hmm.
Which isn't too bad. Most of the others are probably going to keep you at a
So the one that allows a 3.5% down payment, that'll go as low as what credit score?
You're going to be 620.
620 and above. Okay.
Maybe
sounds
you might
good.
be able to get a hold of. You might be able to go 580, but it gets really tough. And
Got it.
So you have so the other thing with FHA is they'll allow for sorry, I was trying to get back to where I was on the page. Down payment assistance. So you can get down
Sure.
payment assistance programs, or you could even go with, like in California here, we have CalHFA, which can take you to 100. So there's a lot of programs out there right now where what will happen is the lender will do a 96.5%. Then they'll give you a 3% second of their own money that's amortized over 10 years. And the
Okay.
interest rate will be just a little higher than your regular interest rate. And this is a
Right.
loophole that a lot of them use. And they'll finance it, knowing that chances are in the next 2 to 3 years, you're going to refinance and get out of the loan. Some will charge you interest. There are some that will charge you no interest. It just depends on how they're funding the program. And then you also have what's called down payment assistance. You can use a down payment assistance program to get the other 3.5%, and you might even be able to get some closing costs. And that's where like CalHFA comes in, where they do a lot of they'll do a second that's an interest-bearing second, and then maybe they'll do some a third, which is a down payment assistance for closing costs, and they can be either you pay interest or no payment on that until X number of years. So you
Right.
don't even have to pay any. It just depends on how it's all structured. There's a bunch of different wacky programs, and to get into the real nitty gritty of them, just know that you can get almost all your closing costs covered in some of these programs if you can qualify. A lot of them are
Right.
income based, so they
Right.
go with either the average income for that area, or they'll do a thing where they say, well, it's 100% of the income, the average area income, based on what the federal government calls it. And then they'll say, well, no, it's actually 80% of the average. To qualify, you have to be 80%. So you have to be below the average by 20%. And then there's some that are like, well, we don't care at all. So
Mm-hmm.
it just gets into just shopping and seeing what you can best get into.
Right. So that kind of, right. So what you're talking about is, as you're shopping, it's probably not to get too deep in this particular thought, but it's probably best to speak with an experienced mortgage broker versus just one bank. Because one bank has a set guideline and that's it. You're either in their box or it's decline. Versus
between a broker and a bank.
right.
So a traditional brick and mortar is going
Right.
to be generally FHA, VA, conforming, and maybe USDA. And that's pretty much it. They're not going to go outside the box, and they're even going to have a whole bunch of overlays. And overlays are basically, so just because FHA can go to do a manual underwrite, if you go to a regular brick and mortar bank, they may not do that. And they may say,
Right.
oh, 580 and above FICOs or 720 and above FICOs.
Right.
Whereas others might say 620. So there's
Right.
tiers in the FICO system that are kind of pretty standard. You know, 720 and above, most people are doing those. Almost everybody will take that. 620, you know, then you got 680 is another like mark, and then you have 620, and then 580, and then from that point on, if your credit score is below that, it gets really hard. There's programs out there, but it gets harder. And the problem is, the lower you go down on that FICO score, the higher your rate goes, and then it makes it even harder.
True.
It
True.
compounds the issue of getting qualified.
Right.
Because generally, at that point, when you're down that low, you are down there because you have a lot of debt or you have a lot of past issues on your credit, negative issues on your credit report.
Right.
Have high balances, which then affects your debt to income ratio, which the higher rate then even compounds on top of that and causes.
Right.
Whereas if maybe you could get that prime rate,
Right.
not prime, but A level paper rate, you would have qualified. But now because you're a 580 or a 620, you know, instead of being like today's pricing is anywhere from 6 to 7%, depending on how you structure it. So, but if you're a 620, you're probably pushing 7 to 8, 7.5 to 8. So that's the
Yeah.
difference.
Yeah.
So that'll immediately hurt you because that's an extra point thrown on there for your pricing.
Right. Well,
So
having a low credit score isn't the end of the world either.
no,
It's not something where you if you see you have a 530, 550, 580, 610, 601, whatever it is, meet with an experienced mortgage brokerage, because we, in our years of helping so many different clients, we can look at the whole credit profile and say, hey, you're artificially low. You pay everybody on time. You're just carrying credit card debt. And it could be that you're high on whatever your limit is in correlation to where your balance is. And, it might be just a 3-month or 6-month pay those credit cards down. And now you're at 680 or 720 and you're in a whole different game, right?
and
Instead of, right.
No, go ahead.
Yeah, I mean, you're just in a whole different game of where you're mentally at when you see a low score. Don't let that mentally get you out of wanting to buy a house. If you have the desire to buy a house, schedule a consultation. It's no cost to you. We'd be happy to do an analysis. It takes us, in about 10-minute conversation, we can give you a snapshot of what to expect, without even running credit. You know where your credit's at. We can work off of what information you have from the credit entities, like if it's Experian, TransUnion, or whatever. We can use some of that to guide you on yes or no hypotheticals, right?
Most people get their credit score through one of their credit cards now for free.
Right.
You can tell us what that score is, and just realize that score is generally what's considered a retail credit score. It's not a mortgage credit score. So you have, retail purchases, and you have car loan scores, and it's the way the system or the algorithm is looking at your credit. And then so we pull a credit score. So we know that generally a retail credit score is going to be better than a mortgage credit score. So if you're telling me it's, 640, I'm probably going to go, well, you might be in the 620s, you might be in the 600s.
Right.
It just depends. The other advantage to discussing your credit report is also if, let's say you're sitting with a high debt to income ratio for multiple reasons. Besides the fact of focusing on paying down your credit cards to help you with your percentage versus your balance versus your authorized amount. So what happens is the higher you get up on, if you have a $10,000 line of credit and you're using $9,000 of it, that's going to hurt your score. So if you can pay that down, it's going to improve your score once you get to 50% of your overall credit line, or once you get down below 25, it really helps.
Correct.
But
yeah.
The other thing that it does is it lowers your payment. And it's much easier to pick up. So when we do debt to income ratios, your income probably isn't going to change. So if we can pay off some of that monthly debt, that's like adding. So if you pay off a credit card that has a $200 payment, that's like giving yourself a $400 increase in pay. That's the way we look at it. It's technically more than that, but on the conservative side, I use 50%.
Right.
So
you're saying that that's a good way to be able to, qualify for a larger payment. Not that we're trying to put you into a payment that you can't afford, but if you can afford it, on paper, you might look like you can't. So the way to manipulate that, or not manipulate it, but get it to reflect your true affordability, is to get these debts in line. Might be a pay down on some of those credit cards,
well,
right?
And a lot of people have income that, while you may have income, you can't use it to qualify. So there's a lot of different income that people have that, they know they have it, but they haven't had it long enough, or what. They know that they can handle the payment themselves, but on paper it doesn't look that way. But we can still get it within the ratios that the loan approves based off of the income that we can show, and help you that way. So
Yeah, I mean, you brought up a good
And
thing that I think
small
we should.
improvements will improve your score also over time. That they're not going to have an immediate. You can't just pay things down and expect it to affect the score
Right.
immediately. It's going to take a cycle.
No,
So
that's a good point.
you have to assume that it may take 30 to 60 days before it actually affects your credit report.
Correct.
So that's why we tell people get to us early. Let's do an initial consult, and
Right.
usually we'll do what's called a soft pull. It doesn't put a pull on your credit report, so it doesn't affect it. Nobody sees it. It's not going to trigger 1,000 people calling you. Because that's the
Right.
thing. If you do a hard pull, uh, um, it it will trigger a whole bunch of phone calls
That's
from
right.
other mortgage companies. And
That's
we
right.
can, we should probably make a note and on a future one discuss how to have your name removed
Oh
from.
yeah, that'd be a great. Yeah, we'll have to expand on that on a separate
Yeah.
video. Well, one thing you mentioned I want to just kind of expand on really quick is the fact that two things. First of all, in regards to paying that debt down on your credit, the credit card companies do not report where your balance is every second, every day, every week. They only report where your balance is once a month. And so that once a month is within a 5-day to 6-day period, usually right around where the payments due. For the 5 or 6 days after, when they say, hey, Rob, your new statement's ready. So in that window of where your balance is, that's when they report it. So it's best to pay the balance as low as you can for that window. And then obviously we use credit cards, right? But just for the reporting purposes and to maximize the highest credit score, that's kind of what we've seen over the years to do that.
That gets into the whole don't take a lot of credit right before you're going to get a mortgage. So don't max out your
Correct.
credit cards. Don't get a new
Correct.
car loan.
Correct.
Don't go take a personal. Don't get a stereo.
Right.
Don't co-sign on something for
Right.
somebody else.
No helping out friends, family with the credit to help them buy whatever they want to buy. Not until you're all 100% closed and moving in. You're moving in. Just look at it that way. Because once you move in, things are going to change in your world. You're going to see things. Oh, I didn't see that before. That corner, I want to go improve that corner. We want to go paint here. We want to go buy this new barbecue or do this pond or whatever it is. Things start to really, the creativity in your mind starts to really go when you start to move in and have ownership of your house. So you want to have access to all that credit, not give it out to friends and family, and overexert.
You don't want to do that and something delays. So let's say you go in and you think you're going to close in 30 days, but the process gets delayed for whatever reason. Maybe you find something wrong with the house and the seller has to fix it before you can close. So now instead of closing at the end of the month, you're not closing until the 30th or the 40th or 30th or the 10th of the next month,
right?
Whatever. And now all of a sudden it requires a repull for whatever reason. It requires a repull of your credit report.
Right.
Things all of a sudden show up that weren't showing up there before, and now you've maxed out all your credit cards, thinking, "Well, it doesn't matter anymore for me," or you quit your job.
Oh Lord. That's a good way.
Funds, you don't change anything.
That's right.
Don't buy a new car. Don't lease a new car.
Right. Right.
Now, here's the thing. If you have to do something, that's fine. But call us and let's
absolutely
before you do it. Because even if you're thinking of consolidating, I'll give you a little. So the other day I had a client who was going to consolidate a debt, and they had a timeshare too, and they called the timeshare to find out what the payoff was, and the timeshare said, "Oh, well, what are you trying to do?" And they're like, "Well, I'm trying to get my payment lower." Well, they took the loan, and they basically sold them they were going to sell them a new timeshare. And the client called me and like, "Hey, will you look at this paperwork? It doesn't look right." Well, he had only I think they only had like $10,000 or $20,000 left on the balance of the timeshare,
Mm-hmm.
and the paper they offered him was going to be $60,000 loan, and the interest
Wow.
rate was going to be higher than what he had now. But what they were doing is he only had like 4 or 5 years left on this thing, and they were extending it out 30 years. So they were telling him, "Look, we've lowered your payment from $1,000 down to, $600-700."
Wow.
But they were tripling his debt that he would
Wow.
owe. Yeah, and they were increasing his interest rate, but they were playing games with the term
Yeah.
in order to stretch it out so that the payment was
Right.
lower. And that's something you have to be careful of. There's a lot of games in this industry that you can do to make something look good, and it's not always in the best
Right.
interest. Now, if you're trying to refinance and your goal is I need to get my payment down to this level so I can handle it because I lost my job and I had to get it. Like let's say you're doing a refinance, and currently your payment is $2,000, but you lost your job and you're like struggling, or there's going to be a cutback at work or whatever, and you're like, well, I need to refinance out of this because I know I got to get my payment down. Well, then you
Right.
might go and extend the loan out longer to get the payment down, knowing that you're going to have the loan longer, but your payment's going to be lower and help you through this period
Right.
and get back on your feet. Or maybe your spouse lost their job, and that'll make you guys, move through the thing by stretching out the loan.
Sure.
Um,
Sure.
so get back on track a little bit with programs. So
Before there's the second point I wanted to expand on just a few moments,
yeah,
because I think both of us can kind of expand it out, because you mentioned something really quick, a couple words, where people might have the income but they're not declaring it, or the income just is earned however it's earned, whether it's through a traditional paycheck stub where there's taxes taken out and documented, reported every month to the IRS, or it might be an untraditional method of income, right? It could be from independent contractor status or freelancing, through a myriad of different channels, right? Gig economy, exactly. Because there's so many different gig style work that's out there. I mean, it's so vast right now.
Right.
So what do those type of people need to consider?
So let's talk about the different documentation types of income.
Yeah.
So you have conforming, which that's basically the best rates out there. And
Right.
the thing to remember about conforming is a word that is in it, which is you are conforming to a specific program to get this price, which means you're showing all your income on paper. And they're very strict, and the guidelines are set in stone, and there's no kind of wiggling around them. I mean, there's different exceptions for different types of income to show, but there's some incomes they're just not even going to accept because they need to show a history. So if you're like in the
Sure.
gig job where you're, let's say you have a regular job, but you also do Lyft and Uber and
Right.
I can't think of what the food thing, the food delivery on the side, right?
Right.
And that brings in a certain amount of income, and you need that income to qualify. That's going to be harder to qualify in conforming than other programs. And the reason being is generally it's not consistent,
Right.
and you haven't been doing it for 2 years. Now, if you've been doing it for 3 or 4 or 5 years, and you can show a consistent amount that averages out over each year, and you can show that, then you can probably use that in a conforming loan. But it just gets really hard.
Sure.
It's going to be a lot, and you better be someone that's Johnny on the spot with the paperwork.
What do you mean, Johnny on the spot? Very good with getting
You're
it.
going to have to have your tax returns. You're going to have all your 1099s
Got it.
for each of your different. Like you'll have to have one for, Lyft. You'll have to have one for Uber. You'll have to have one for DoorDash. Like I've got a guy who I do loans with. I've done a couple loans with, and he's got like 4 or 5 different things that he runs out of his car, delivery company, things.
Yeah.
And we unfortunately we couldn't use any of that because he was not consistent with it.
Got
And
it.
nothing against him and nothing against the income. The income was there through it. He had a regular job too, just so you know. So that's how
Yeah.
he qualified.
Yeah.
But that income we weren't able to use because sometimes he got more business from Uber than Lyft. So the numbers didn't slide as easy. And the time we were doing this gig economy stuff was uh, the lenders didn't really understand, so they were real strict on it and they didn't want to do it. But now there's programs for gig people. And the underwriters are kind of understanding it. And if we can show it, even though it's multiple um,
Sources.
let's call it employers or
Got it.
contracts, because really you're not an employee, you're a 1099er. If you have multiples, if we can show that you're consistently making the same amount year to year through all of them, but the number is fluctuating between the specifics, we can probably have a good argument for, well, this year Uber paid better, so I took a lot more Ubers, or
Yeah.
Lyft had this extra surcharge, so I stopped doing Lyft for 6 months, but I tripled my Uber business or
Right.
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 So if we can do a letter of explanation and show all that and document it and show, yeah, this one dropped, but this one exploded,
Yeah.
they may be willing to look at that. So
Now, just real quick, we can't use a letter of explanation to show income. That's just to explain what documentation we provide that shows the income. So in that type of situation, what documents would they accept?
right. So when the underwriter's looking at it, there's something there explaining why it is what it is. So they don't just look at it and go, well, this, because they get real narrow and they'll look at just that one employer.
Right.
Or contractor, and they'll go, well, he's only doing this amount.
Right.
And they'll average it out. And they'll go, oh, it's the income is decreasing on this one, so we can't use it. They won't want to use it.
Right.
And then the other one, they're going to say, oh, well, this is rapidly increasing. This is too much of an increase as a percentage. But if we can explain that overall, every year you're making the same amount, it's just changing within those things based on, the need or the comp plans or whatever, then we have a better chance of getting them to bite on it. And as time has progressed with these jobs, they've seen a lot more of them now, and they're a little more understanding. And then
Cool.
there are other programs that we can use. We don't have to do this. So the other option would be, we have W-2 wage earner.
So that's a traditional paycheck stub where you clock in, clock out, have all the breaks, and they take out the taxes, Social Security, and all that.
Commission, less than 25% commission.
Got it.
All right. So you're just going to get away with current pay stubs, last two pay stubs, and last 2 years W-2s. All right. No tax returns, no nothing. Then if you're a 1099 or you're a commissioned person that's W-2'd, 25% or more of your income is commission, then you're going to be doing tax returns along with your pay stubs, your 1099s, your W-2s, your whatever all the different receipts you have for your income. So we do full tax returns plus all those.
Got it.
If you are self-employed, then boy, my voice is cracked there. If you're self-employed, you're going to have also, so if you pay yourself, you're going to have a pay stub. If you W-2, you're also going to have a K-1 and a tax return. Sometimes, so like let's say it's an S Corp or a C Corp,
yep.
You may also have partnership paperwork. You may have business bank statement. I mean, not business bank. You might have business tax returns that are required if you're self-employed. It just depends on the structure of your business and how we're trying to show it.
Right.
There are also programs that are just 1099 only. So you just show all your 1099s. Now you're not going to be getting to 100%.
100%, not 100% financing where you come in with zero money out of pocket on a house, right?
you know, you're gonna like
Was it 10% down? 15?
let's see here. This is 15%, 85% LTV. I'm trying to find one for a purchase.
Got it.
Let's see here, gig. Yeah, these guys are allowing 90%. And they specifically
Which means 10% down payment and whatever closing costs in addition. Or hopefully credits from the seller for to pay some of the closing
and they'll
costs.
finance up to $4 million. Yeah.
Oh, so that's a great program.
So that's 1099. Another option is P&Ls. So let's say
P&L's profit and loss.
correct.
Okay.
Sometimes they'll require them signed by a CPA. Sometimes they'll just require them signed by an officer of the company.
Right. Usually when it's CPA signed, that usually means the CPA is somewhat auditing that, correct?
A CPA is not going to sign your financials if you're fudging them. Let's just put it that way.
Right. Which means it has to be legit. What's being reported or has been reported to the IRS and any state entity.
Right.
So, yeah.
And that's going to happen more if you like own maybe a C Corp. You're probably not having a CPA do your books if you're a smaller guy, but you might.
Right.
Sometimes they'll require that along with bank statements, and it'll either be 12 or 24 months bank statements. And so that's another way you can prove your income if you're a 1099 or commission salesperson. Or
I mean, so bank statements, I mean, can I just use 1 month statement from my best month of this account over here and then my best a month from this account over here and kind of pick and choose which ones? Or does it have to be all consecutive? Go ahead.
This is where you have to make sure you are doing you're really tracking your business and how you do it, because what they're going to do is they're going to go through, you're going to have to provide 12 months or 24 months of bank statements, all pages.
Even if they're blank.
There can be no gaps.
Right.
So if it's from January through December, you better have every single bank statement in there. And then and then if your bank statement says 4 or 6 pages, even if 2 of them are blank, you have to include the blank pages. They will audition for it later on.
That's right.
Because they want to know what's on those blank pages. And then what they'll do is they usually will have a spreadsheet they work on. I mean, that's usually how I do it. Is you break it down, you put it all into a spreadsheet.
Right.
And they will look at deposits and withdrawals. And they'll look for anomalies. They will also look for wire versus check. And they may throw some stuff out. So they will definitely throw out large checks. So let's say your average is going along at $5,000 a month, and then you have 1 month that's $20,000. They're going to throw out that $20,000 deposit. Unless you can show that it is not an anomaly, but a reoccurring event. So let's say you have a contract with somebody. So if you're self-employed and the majority of your work is done in the latter part of the year, but all your checks come in on, all your vendors pay you at the end of the year, and your payments always roll over till the 1st of January.
Mm-hmm.
So maybe you get, 20, 30, 40% of your income all deposited in 1 month, because a lot of the work you do is, I don't want to call it seasonal, but you have a bump during the holidays, let's say.
Right.
So
understood.
And then so that rolls over. So in that case, we're probably going to want to go 2 years bank statements to show that you have a consistency. They will even sometimes, if they're not happy with it, they'll say, okay, well then show us 3 years.
Right.
And if you're somebody who has been in business, if you're claiming that you've been in business for 5 years, you can show the pattern. they're going to use the more recent deposits to determine how much you're making. Even if the worst thing you can say to them is, "Oh, I had a really bad year, 3 years ago." Yeah, but did you have the majority of your paychecks or your checks come in during this month like you always do? Yeah, it's just, it wasn't as much. I was still growing, but it's still the same. 40% of the checks came in January, and the rest of the year kind of trickled because it was small work.
Right.
Well, then that's where you do, before we submit it, we would do a letter of explanation. We'd work out, we'd work out, we discuss how your business works, and then we determine how to write up a letter of explanation. We write up a letter of explanation, and we'd include it in with the thing explaining why this income all comes in a lump sum. And they will also look at wire transfers and see what kind of accounts they're coming from. So if they're coming in through an account that they can see is yours, and you're just rotating money in and out of an account. So if they're seeing every month that you're depositing $500 and you're depositing $500, so you're taking out $500 and you're depositing $500, they're going to question especially if it's cash, they're going to question if you're manufacturing your bank statements. See how that could be fraud?
Yeah.
So let's just say that every month you've got a little bit of cash and you're trying to make your bank statements, in a year or two, you want to make your bank statements look good. So you start depositing $500 a month in cash, and then you take $500 out the next day, and then you do it again. If they start to see those kind of patterns, they're going to start to question them too.
Got it.
And they're going to say, well, where's this money coming from? So just be careful with that stuff. You don't want to be in a situation where they start to feel uneasy with it, because then it's going to start being conditioning. And ultimately, they have the ability to say, we're going to accept those deposits or we're not. And if they feel comfortable with the deposits, they're gonna not give them to you, and then your income's going to go down, and your ability to qualify is even worse. So just realize that. Some other programs that you have besides that are asset depletion. And that's where, let's say you're somebody who has a lot of cash. Let's say maybe you're closer to retirement and you have $2 or $4 million, or you won on the lottery, and you have a lot of money sitting, but you don't work anymore, or you work very little, or you do volunteer work. Well, there's a formula we use where we basically look at how much cash you have, and we figure out what your current expenses are, and we see how many months of reserve you have and how long that can take you out. And it's the number of months that they're going to require that you have in reserves depends on each lender. So I won't even try to get into that, but that's another. So that's asset qualifying. And we covered bank statements. What else do we have here?
So yeah, we spoke about the traditional pay stub, which everyone kind of gets the idea of that. We spoke about if they're a gig worker and they have 1099s coming in, which means they're not paying taxes as they go, and they're getting a net check and get a 1099 tax document at the end of the year. We're talking about bank statements. We spoke about the tax returns a little bit based on businesses, and if they want 2 years or possibly a third year if things don't look right.
There's also another new one that's kind of popping up more and more is a VOE only, verification of employment.
Okay.
You're going to be putting more down. You're going to be putting at least 20% down on those programs, and you're going to be required to have higher credit scores.
So can anyone do a VOE, or who does a VOE apply to?
It's going to be someone that is having a hard time proving certain things. It's going to be like Um, it's going to be for somebody that has like some kind of an issue and we just need to prove that they have a job. It's almost like going no income, uh, no doc loan, you know, that we used to have. Believe it or
Yeah.
not, there's still some programs out there. I mean, there's a lot of stated income verified asset programs still. Now, these are generally used for investment properties.
And they're not, those stated income or unverified assets would be something where they're not low, super low rates, right? That's a little higher interest rate.
They're more business purpose loans. So,
Got it.
did that light help us or hurt us here?
No, it's good. The light was good. Yeah.
All right, good. Um, yeah, so they're going to be more business purpose. So let's say you're looking to buy an investment property.
Yeah.
You're not going to be able to use it buy it. You're not going to be able to use it to buy a primary residence. But I don't want to get off on those. I want to stay right now on primary residence because
Agreed.
there's a ton of different weird programs for people that are looking to buy investment property. And generally, what we're trying to do is talk about a first-time home buyer. So I kind of want to stay there.
Absolutely. For sure.
The other thing that you're going to, let me see, I want to make sure I don't miss anything here. So for programs, we talked FHA. We kind of talked conventional, which is Freddie and Fannie. And on those programs, believe it or not, there are some lenders out there that'll let you get to 100% financing. They usually will offer either a down payment assistance program or their own program, where similar to the FHA, they will do a loan and lock you in for so many years on that loan.
Right.
Then you have VA. So if you're a
Okay.
veteran, that's a great program for you. And right now, the VA rates are probably more aggressive than the others. And on that, you would want to, you can go zero down, so 100% finance.
Yeah, that's a great program. And I think the mortgage insurance rate is a little less or lower.
There is no mortgage insurance. They call it a funding fee. And so with the funding fee, everybody likes to say, oh, well, there's no MI, there's no MI. Well, yeah, there's no MI, but they have a funding fee, which
MI meaning mortgage insurance, right?
mortgage insurance, right?
Right.
So on loans above 80%, you're going to have some form of MI. And on FHA, you're going to have MI, and you'll have upfront and continuing. So, you know, like if you do that, they'll just at the beginning of your loan, if your loan is 100,000, they're going to throw another, I don't know, what is it, like 17,000 on there or something. I don't know. Can't do the math right now. 17 or $20,000 as a funding fee, plus then you're going to pay a monthly MI that doesn't go away.
Right.
So you know. So in the old days, you used to be able to, on FHA, you used to be able to pay it down to like 80 or 79.999%, and then MI would go away. That doesn't happen anymore unless you're in a 15-year mortgage.
Interesting. So they changed that rule.
Right. And they're constantly messing with the, well, not really, they haven't messed with it a lot, but they're also on the upfront. And there's different ways to do the upfront. You can pay cash for it, you can finance it. Most people, 90% of people finance.
Right. So real quick, you mentioned Fannie Mae, you mentioned Freddie Mac, you mentioned CalHFA. Do I just go and find Freddie Mac's retail location or Fannie Mae's retail? How do I get these loans?
Freddie and Fannie don't do loans. They buy loans.
Okay.
They set the standard, and then the underwriters underwrite to it. And if you underwrite to that standard, they will buy it after they review it, if it met the standard. So you would go through a broker like us, or a
Right.
lender, a direct
Right.
lender, or a brick and mortar bank.
Got it.
So um, the difference is generally a brick and mortar, uh, a traditional bank will have very conservative guidelines because it's not their bread and butter. They're offering it as a service. They're not offering it they don't really want to deal with all the problems with it. So they want easy slam dunk loans. They want people that are, while they can go below this, they generally want people 720 and above, A paper, W-2, or they will do loans for people that have large deposits in their bank, and they will sometimes do the extra mile, even though they don't want to,
Right.
because they don't make the majority of their money off lending. And when times get tough, they tighten up their guidelines the most. They do a lot of overlays. So maybe they don't want loans that are at 50% DTI or 45% DTI. They want all loans to be below 35% debt to income ratio, regardless of what Desktop Underwriter DU will approve. The Desktop
Interesting.
Underwriter is the automatic software that underwrites the loan before it goes in front of the underwriter to manually look or review
Right.
the document.
Right.
Because really, unless they don't really make decisions, underwriters, they review the document to make sure it meets the guidelines. That's what they do. They're more like a QC, but they have to also
Quality control.
So I'm not knocking them
Right.
and saying they're just a QC person. That's a little insulting. They're not. They have to understand the guidelines and know how to do it. But
Right.
it's not. There are very few manual underwriters left in the business that can actually do a true manual underwrite where they're looking at risk and things like that.
Right.
Most underwriters underwrite to the guidelines, and that's
Got it.
so. So yeah, you have Freddie and Fannie. Then you have VA. Same thing with VA. You don't go to the VA to get a loan generally. You go to a broker, a direct lender, or a brick and mortar. So the difference between a brick and mortar and a direct lender is a direct lender is somebody with a warehouse line or a line of credit. They fund their loans, and then they package them and they sell them off. So
Pretty quickly, right? Usually within days or a couple weeks,
well,
months.
If they're, this really gets into the weeds, but
Sure.
there's what they kind of, I would call a table funding direct lender versus a true direct lender has warehouse lines and stacks up large quantity of loans. So
Yeah.
there's some that fund them in 3 to 5 days, 10 days. Basically within 30 days, they're selling them off their line.
Yeah.
That's more of a, so that's where we would go to if we ever got big enough to where it justified becoming a lender. That's your first step, becoming a lender. All right.
Right.
And then from there, you kind of go to more complex direct lending, which is you'll bundle and you'll hold them from anywhere from 30 days, from 1 month to 6 months to 12 months, maybe even 2 years. And you'll package them up and then sell them.
Yeah.
So they may retain the servicing rights for that time, but 30, 60 days later, after you've closed your loan, you're going to get a notice from either Freddie or Fannie that they sold the loan to them, but they're retaining the servicing rights, which means you keep writing the check to that lender, but they've sold the loan to Freddie or Fannie and it's on their books and they own it. And they then pay so many basis points of the loan interest rate to them to process the paperwork and collect the funds, make sure you're paying on time. If you don't pay on time, they chase you down, all that kind of stuff on behalf of Freddie and Fannie. This really gets into the weeds. So
no worries. We'll leave it high level. We'll leave it high level there.
So that's the difference. And generally, a direct lender is going to want to, they can still broker loans. Some do, some don't. Some do a combination of being a broker and a direct lender. But they're going to try to drive you to that direct lender product that they can sell because they make more money on it. And they don't have to disclose as much. And that gets back to our previous video where we discussed about the differences on disclosing how you're paid. You know,
Right.
banks and lenders, direct lenders, they disclose different than a broker. Let's just put it that way.
Yeah.
And so those are the three places you're going to probably go. Now there's some independent nonprofits out there. They like to claim, you know, we're a nonprofit and we can help you. Well, I think we talked about this before too, so I'm sorry if I'm repeating myself. But they're basically somebody, instead of incorporating as a corporation, they incorporate, or they set up as a nonprofit, and everybody there is still getting paid. It's still
Right.
a sales thing.
Just because they say they're nonprofit doesn't mean they're not earning money.
Profit,
They're earning money.
yeah,
Right.
paying it all out in salaries.
They're probably some of the highest paid nonprofit workers out there. So,
And they may be donating a portion of it, and that's where you'd have to figure out, well, how much are they donating? If they're only donating, you know, like if they're a nonprofit and they're saying, well, what we do is we do free trainings or this or that. So what percentage are they giving back is what I would ask. Because, and I've sat in trainings with some of these folks, and you know, they loved working there because everything was, oh, but we're a nonprofit. See, we're not overcharging you. And I'm like, I've seen the rates you quote.
yeah, sometimes the rates you're saying just because they're a nonprofit doesn't mean the rates are better, right? It could be more expensive.
But there are some out there that might be, you know. So,
Right.
you know, this is what it is.
True.
So then you have that. You have VA. We were talking about VA, and then you also have CalDRE, which is available, which we can help you with on that too. And there's advantages and disadvantages between CalDRE and then just VA.
Right.
And what we can do is we can take your application, fill it out, discuss it with you to see which way is better for you, and then push you that direction.
Right.
Depending on. And then you have USDA, which is more of a rural loan.
But that's an interesting loan when it's available, right? What's the allowed financing percentage? Is it 90%, 93%?
100%. You can go to 100% on that too, but
wow, 100%.
It gets really difficult because a lot of people end up looking at like, you know, they claim they can do manufactured homes and that kind of stuff, but then it has to be a brand new one that is being placed on there within. There's just so many rules to it. If you're looking for you want to find it with a single family is what you want. If you're going to
use a single family, not stay away from manufactured. Okay.
Yeah. I mean, I'm not going to say no. I would say, hey, I found this property. Will you look at it? And then I'm going to probably throw 20 questions at you to find out, to talk to your realtor, or give me the listing so I can see if I can look up the listing and get some information on the property. But it just gets really difficult. I've had a lot of situations where we were trying to go that way, and we actually ended up going FHA or conventional.
Got it. And that's just to reiterate, that's the beautiful part about dealing with brokerage is if we think something's going to work out right and it just doesn't, we can, be nimble and switch right over here to another program that we're not we're not just looking at it from that one lender guideline rule. So yeah, there's multiple.
It will be frustrating to the client, to the consumer.
True.
Because they thought they were going to go one direction and now we're going another way. And we're just, to us, it happens all the time. So we're not as flustered by it. And we're like, well, let's look at this other program, flip it over there. Can you handle this payment? Maybe the interest rate is a little higher, but you can still handle it, but we're able to get it done.
Right.
And that's sometimes more important than, what's your motivation?
Right. And back to, I mean, just to, go a little deeper on that, if somebody's been paying rent, and it's been increasing every whatever amount of time, 6 months, year, and they've made the decision they want to buy a house. They want those tax benefits. They want the appreciation of equity. Maybe they have some plan, to go have multiple homes down the line, and they want to get this first house and mortgage history established so it allows them to do that later on. Sometimes it's best, even though the interest rate might change a little bit because things have come up during the application process. We might have to switch that program, even if the payment does adjust a little bit, the rate does adjust a little higher. It's better to close and start getting that mortgage history, that equity, that appreciation, the tax benefits now, knowing that you can date the rates and you can always refinance later, right? You can refinance it 2 years, 3 years, 4 years down the line.
Rates are better. Yes.
Right. Assuming it's better. Correct.
I've got to throw a disclosure in here because you used the bad word, tax benefits. That doesn't mean that you're always going to get tax benefits by owning a house. So that is
correct.
something you have to talk to your CPA about or your accountant.
Absolutely.
I find that even me, I end up with they've raised the standard deduction so high that it's hard to itemize.
Yeah.
So just realize, yes, there is a possibility that you might be able to take advantage of some tax breaks, but they're not always there. And it's really on a case-by-case basis. But there are a lot of advantages to owning your own home. One, you're locked in at the price that you're at. You're not answering to somebody on a day by or a monthly basis about your property. All you're doing is writing a check. Because the lender doesn't care what's going along as long as they get their money. They're not going to come knocking on your door. They care about basically three things. You make your payment every month. You're paying. You keep your insurance policy in effect at the proper levels, and you pay your property taxes. Those are the three, and you don't burn the thing down or destroy it.
Right.
But really, those three things are the things that matter. And the nice thing about if you get into a property and you're in a fixed rate loan, your rate doesn't change. You're not affected by increases in the market for rental.
Right.
And right now, there's a lot of people feeling the squeeze on rentals, especially in Southern California. So, hold on one second. I just want to make sure I didn't miss anything here. Another thing I would say is if you're a first-time home buyer is set your expectations right. You're not buying your forever home, generally your first home. And if you're young, I wish I knew then what I know now. If I was 18, 19, I would have bought when you're young, you can live anywhere for the most part.
Right.
And I did live in some areas that most people don't want to live in. And if I was smart, I would have bought a condo or a house in a depressed area, lived in it while I was going to college or while I was working in my 20s, filled it up with roommates, and lived in it for 3 to 5 years and then moved on. But kept it and rented it out as a rental because over time, that thing's going to pay for itself and then you're going to have income from it. And that's something else you might want to look at as a first-time home buyer. Well, maybe I look at a 2-unit or a 3-unit or a 4-unit.
Right.
And I use some of the rents from those other units to help pay the mortgage. Sure. Yes, the house will cost more maybe, right? So if you're buying a 4-unit in Southern California, you're probably talking $1 million and you're thinking, oh my God, I couldn't afford $1 million loan right now. But if each one of the units is paying, $3,000, $4,000 a month, depending on the area, maybe even more.
Right.
Now they're actually paying the majority of the payment. You're talking, let's say it's $3,000. Well, if it's a 4-unit, that's $9,000 towards your $1 million payment.
Yeah, all of a sudden you can afford it.
Right. And then maybe you live in it for a while you fix that one up, and then somebody moves out of the other one, you move over to the one that needs, that just moved out, and you rent this one out at top rent because you've fixed it all up. Not crazy. You've brought it up to market standard, and you've painted it, you've improved it, but you haven't
Right.
over improved it. And then you move to the other one and you live in that, you fix that up till another one opens up, and then you move over there and you bring the rent up to market rents. And that's how you increase your income on that property. Is you be a little more flexible, and you say, my goal is to live in each one of these as I can, and fix them up, and then rent them out at top of the market, the current market.
Right.
And then you do market increases, annual, minor ones. You don't go greedy. But it's
Right.
easier to raise the rent when you have someone new coming in than it is to raise the rent on somebody that's in there already.
True. True. Got it.
So you could look at a 2-unit. Maybe maybe if, let's say, all you could afford is a $300,000 or $400,000 house, and everything you're looking at is really hard. There's not a lot of stuff available. Maybe you find a $600,000 or $700,000 one that's a 2-unit, and you buy that, and you're getting $3,000 a month or $2,000 a month for that other unit.
Right.
It helps subsidizing, the extra payment.
Right.
And you live in it for a couple of years, especially if you move into an area. So like if you're a kid and you're going to college, you look in an area near the college, you try to find something. Generally, those markets, the college areas, are kind of pricey because everybody's doing it. They've learned that little hack. So maybe you go a little further out, and maybe maybe it's a 2-bedroom and you get 4 people to live there. Or if you go crazy, you put bunk beds everywhere. Rent out.
There we go.
But those are things that people do. They call them house hacks. And then
Yeah, well, go ahead. I was just saying we've covered quite a bit. So
we rambled like a couple of raving.
No, it's good. It's good. It's good if kind of breaking it down to hopefully make it make sense to people that we're in this renter only world for a while, and they're like, hey, can I buy a house? My score's not that high. Do I have to have an 800 FICO? Do I have to have a 780 FICO? No, the answer is there's a lot of flexibility out there.
Well, and I would also say that, let's say you can't qualify now. I work with a lot of people that a year, 2 years later, they come back and they buy a house with me.
Right.
So sometimes, if you're interested or you're thinking long term and you don't know, maybe the income isn't there. We pull your credit. We'll do a soft pull, so it doesn't cost a lot of money. We review it. We tell you what we see on it. We tell you where to work on it to get your scores up.
Right.
And we also discuss, what's your potential for this? Or, what's your job future? Well, I'm looking to this or that. Okay, well, I'm looking to go into this type of line of work. How is that going to affect me in qualifying? So maybe they're moving from a W-2 job to a sales job.
Right.
Well, this is what you want to make sure you do to prepare. These are the documents you're going to need to make sure you're getting. Well, I work in a cash, I do a lot of cash work. Well, I'm sorry, cash isn't traceable. So you're going to have to find another way to get that money into your account.
That's right.
So it's and just throwing cash deposits get backed out of bank statements. So and it throws up all sorts of red flags for all sorts of things. So maybe you, I don't know, deposit money, go down to the U.S. Post Office and buy a money order deposit. I don't know. Or maybe you have money coming in through Zillow and all these other things.
You mean Zelle? Zelle or
what did I say? Zillow?
Yeah.
Sorry. Yeah. I
Zelle.
was just talking to somebody about Zello earlier, so that was still in my head. Yes, Zelle and PayPal. If you're getting
Right.
paid through all those type of things, it's just, you have to make sure that we can go through and we can find it. You know.
Right. That it's documented in
Correct.
certain methods. It makes
That
sense.
gets really complex, and a lot of people don't keep their documentation or don't keep track of it, and so that's understandable.
Right.
Also, if you're someone who gets seasonal work, so that's another thing. Maybe you only work 3 months out of the year. Like, let's say you go up to Alaska and you work on a crab boat, but you make
Right.
$100,000. That's okay, as long as we can show 2 years of that with a likelihood to continue. We're okay. Or maybe you're a seasonal lifeguard or a seasonal whatever, and in the off season you do something else. So we document the two different jobs, and we calculate out a history on it.
Right.
Yeah, no, I think we're rambling, but
No, it's good to explain
well,
the width and the creativity. So
we're still new at this podcast thing, so you know we need to do repetitions anyhow. So even if we, as the kids say, hit the like button. We don't care if it's a positive.
like,
Yeah,
share,
just like,
comment, subscribe.
yeah. Tell us how my hair's too long or something. I don't know.
Right.
Take anything.
Actually, mine's too long. It needs to get shaved again, but we will save that for a different episode.
But yeah, we'd love to earn your business. Feel free to call us if you see this. If anybody watches it.
Yep. Phone number's at the bottom of the screen, everyone. Prominent Lending Group.
Okay.
Website URL is there as well. And there's a few links below the video that kind of tell you how to interact with us, that take you to scheduling an appointment with us as well. Or just leave a comment. We'll be checking it out. Thanks for your time, and we'll see you on the next episode. Have a good night.